Hello and welcome to the Premium Account Market Update for November 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today is myself, Leon Hine, Managing Director of Investor Signals. I have 18 years of experience in the financial services industry and a licensed securities advisor and derivatives advisor. The format for today's presentation, we look at the global macro update driving equities. We roll through the ASX top 50 with a particular focus on FY 17 and FY 18 earnings. We look at the technical trends, portfolio allocation, and conclude with the market outlook. The Investor Signals Premium Account service is based predominantly on an ASX top 50, a portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We look at effective ownership around ex-dividend dates, generating above average cash flow, capital growth, all in a strict investment mandate. And importantly, the assets remain in your name. If you'd like to know more about the service, please contact me on the 02 Sydney number or leon@investorsignals.com. Moving straight into a graph of the actual XJO, I think if we start here, I'll look at the US market, look at the bonds, and then move into the top 50. Whilst the US equity market's still in an uptrend, the Australian market's got a structural higher high and higher low pattern, which is bullish, but we're just starting to see the early stages of the market break down below this 5,200 level. I think if we were to see sort of it move back down to the lower band there of 5,000 and struggle within that range, I'd be cautious that the market's heading lower. Right at the moment, that's not my base case, and I think the main reason why that's so is the S&P 500 earnings are meeting that sort of $30 to $32 range for the third quarter, which I think underpins US equities. We've obviously got some volatility that's been driven from the prospect of higher interest rates and the upcoming election. On that higher interest rate point, this is a graph of the 10-year bonds in the US, and we see the yields run from 1.3 up to around 1.8. So what that's telling us is the bond market's pricing in a rate rise in December, and possibly even maybe one or two rate rises in FY 17. Remembering we went into 16, I should say, so we went into this year with the market pricing in 4 interest rate hikes by the Federal Reserve, and they never materialised. So I think it's difficult to say with any degree of certainty that we're going to get the rate rises over the next 6 months that the market's pricing in, but nevertheless we're seeing a big adjustment in equity valuations, especially domestically when we look at the infrastructure names, and that'll be part of and property trust, which will be part of the focus of today's presentation. AGL at these levels trades on about a 4% a yield, about 17 times earnings. I think up here the stock starts to get a little expensive, become a bit cautious on it. We own it at or near these levels, but we've been pretty aggressive with selling covered calls up at around 20.50 to complement the income there. Amcor, I think this should be on your watch list down here at 18 times earnings, 4% dividend yield. I think they can deliver 8% earnings growth in the next 12 months. Could trade back up to around 15.50. Then I'd be looking at selling covered calls over it. AMP, we've seen them announce significant write-offs and downgrades to their life insurance division. I think the wash-up of this is the market will start to refocus on AMP as a wealth management company, and I think the stock can probably trade back up to around $5. That'd put it on about a 5.5% dividend yield, and I think the stock can probably recover from where it is, but certainly be looking at running protection below $4.40 on any sort of bullish sort of positioning there in AMP. ANZ, I think there's a real highlight as to how weak the banking results are at the moment. I think ANZ pulls back to around 25.50. It's the only bank within the major 4 that have actually broken out and created this higher high, but I wouldn't be a strong buyer of it until it pulled back to around 25.50. ASX, I think it's good value back here, trading at about 20 times earnings. And then let's put this in context. So this is a stock that's growing at maybe 5% earnings growth per annum. It's trading at 20 times earnings, and it's on a 4% dividend yield. So when we say it's good value compared to historical standards where ASX would trade on maybe 14, 15 times earnings, it's on a very high PE, and that's a function of low bond yields globally. As bond yields push back up, the argument of these equities trading on high PE valuations diminishes, and we're starting to see a fair adjustment across equity markets already on a small move higher in US interest rates. Obviously, the risk is if we do get back into a period of normalization where US rates go back to sort of 2 or 3%, then the equity market remains vulnerable. But I think that's more of a 1 or 2 year situation, whereas earnings grow and dividend and bond yields increase, then you're just not going to see the share price appreciation from a value standpoint, even in an environment with increased earnings. And I think that's a really important message in today's recording, and I think that's why using covered calls is an essential part of a portfolio strategy at the moment, because on all probability, the most likely, I think, sort of action within the market over the next 12 or 24 months would be sideways consolidation. So ASX down here at around these levels, I think it's okay value, but we only want to be using it or buying it on the basis that we complement it with a covered call. AZJ, I think it's expensive up here. There's a chance that they cut dividends next year. I think it weighs on the stock price. BHP, I think this is just fair value where it is at the moment. We sold the 22.50 calls into January. We collected that, into October. We collected that premium. We've resold those calls again now at the 24 strike into January. So we're driving a good amount of cash flow from BHP to complement the dividend. And at this stage, we're sort of staying ahead of the wave there, that as the price rises, we're not getting called away on the stock. So that's helping to add to the returns there. Brambles, again, expensive for industrial stock, 20 times earnings, 3% dividend yield, but I think it finds support here. The prospect of them trading back up and taking out these prior highs, I think, is very low. For me, the upside target on Brambles is about $12.50. Don't see it doing anything more than that. Therefore, that's a level that you want to be selling calls at. Commonwealth Bank, again, when you look across the results from ANZ, the results from NAB, the update that we've had from Suncorp, I think the general message is that the banks are really struggling to grow revenue. Cost control becomes a focus of the business, but even in that environment, I think we're sort of seeing contraction in profit margins, or maybe, at best 1 or 2% underlying growth. So with CBA here, it's on about a 5.8% dividend yield. I think it kind of probably bumps along sideways at or near these levels, but as you can see from the chart, we've got lower lows, lower highs, and the pressure's still to the downside. Coca-Cola broken out, created a new high. I think at around $9 it's a buy. Fair value is $9.50, puts it on 17 times earnings and almost a 5% dividend yield. Again, we've been pretty aggressive with selling the covered calls here to try to drive the extra income from Coca-Cola. Computershare, I think this continues to be pressured to the downside. 15 times earnings on a 3.5% dividend yield, but I think there's some uncertainty around the earnings growth for it. CSL's a buy down here. It's a counter trend trade. We've seen it break lower, take out the prior low. I think if we do get a bounce up to around 105, 108, don't see it doing too much more than that, and you'd want to be selling calls or just taking profit outright on the stock. Caltex should find support here at around $30. Stock trades about 14 times earnings on 3.5% dividend yield. We're yet to see the outcome of whether BP or Caltex get up on the takeover of Woolworths petrol stations. The prospect of BP coming through and trumping Caltex's bid is weighing on the share price at present, so that remains unresolved. Dexus, I'll skip through that. Goodman Group, I think this will probably bounce off these levels. It's not a stock we focus on, but it's trading about 16 times earnings. The yield's gone from around 3%, now pushing back up to around 3.9. GPT, we actually like that at these levels. I think on 15 times earnings on a 5.25% dividend yield, I think GPT can trade back up towards $5. I think the catalyst is an outcome for the December election. So we may have to be patient, but over the next sort of 4 or 5 weeks, I expect the stock to trade back up to that $5 level. But I'd seriously be aggressive with selling covered calls or looking at exiting the property stocks as they sort of recapture at least half of this sell-off that they've gone through over the last couple of months. Insurance Australia Group, you can see there that we're a little bit cautious on that, had a lower high structure in place. And pressure appears to be the downside there. Incitec Pivot, not doing anything there, but keep this on the radar. If we start to see it break up through $3, I think it could be sort of a trough that's in place with Incitec. The longer term fundamentals over the next 2 or 3 years actually look okay for IPL, so you could be looking at a good buying opportunity there, but at the moment the trend's still down. James Hardie, still expensive at sort of 21 times earnings on a 3% dividend yield, but I do think, even with interest rates ticking a little bit higher, still the housing market in the US remains a bright spot of the economy, and James Hardie should benefit from that. Lendlease, I think maybe we start to see it move off this support level, 10 times earnings, 5% dividend yield, delivering 8% earnings growth, and the company's reaffirmed the earnings outlook. Not doing there in Mirvac at the moment. Medibank, this is one that I'd highlighted as a buying opportunity at around 230. I said it'll trade up to around 260, then look to sell the covered calls. Don't see it doing too much more than that, and that's simply a function of not much more than about 5% earnings growth, 4.5% dividend yield. Don't see the opportunity for it to do too much above that. Macquarie, they've come out and delivered just over $1 billion of profit for the half. I think that means that maybe at best the company delivers $2.1 billion for the full year. If they do that, then arguably the stock's just fair value where it is at 13 times earnings and roughly a 5.5% dividend yield. I think sort of it mostly tracks sideways at the moment. NAB went ex-dividend today. We've seen it sell off by probably another 50 or 60 cents on top of the dividend. And again, I think that's just reflective of a lower earnings outlook for the banks and a high probability that they continue or they look to reduce their dividend payout ratios over the next 12 months. And there's a strong argument that they're going to need to raise substantial capital to meet their Tier 1 capital requirements over the next 12 to 24 months also, which will weigh on the prices. Origin, these energy names are under pressure at the moment as oil pulls back from sort of $52 a barrel back down to 44. As we approach sort of the OPEC meeting, and Origin, Santos, Woodside are all under pressure as a result of that. Oil search down here at around 650, I think starts to look interesting. I think you may see it bounce off that level and trade a little bit higher. Qantas, we've been on the short side of that. I think the pressure's still there to the downside. QBE, surprisingly, even with rates moving higher, QBE is sort of struggling. It's had a little bit of a bounce, but we don't see sort of too much on offer there. Ramsay Healthcare, I think maybe on a pullback to around $70, we could see it put in support level, but it's trading on about 26 times earnings on a 2% dividend yield, looking for about 10 to 15% earnings growth. But any sort of high PE stock's been harshly dealt with at the moment in the market. Rio, as I spoke about in last recording, when you take spot prices for iron ore and in the case of BHP, including energy prices, the resources really are fair value at the moment, trading on about a forward dividend yield of about 3%. A lot of analysts have the resource stocks rolling over middle of next year with commodity prices pulling back. But for the moment, we continue to watch the technical patterns which show that prices are pushing higher. But I think we're getting fairly close to levels where you could take advantage of selling covered calls to enhance the return. So here's a great example in the property sector where we've had over a 20% correction, where the yields here started to compress down to sub 4%. Now we're back on a yield of about 5.2%. I think the stock in general, all the property names will probably find support at or near where they are. The catalyst will be the December rate rise. We may see a rally back up to higher levels. Don't expect it to recapture any more than 50% of where it's sold off from. And then I think you just need to be cautious on some of these defensive yield names coming into the new year. Seek, I actually don't mind. Seek will be interesting to have a look at their earnings result in February. I have the stock trading at about 21 times earnings on just under a 3% dividend yield, but the company should deliver about 10-15% earnings growth. Stockland's reaffirmed their outlook for a solid 8% earnings growth. That puts a stock on 14 times earnings and almost a 6% dividend yield. The technical structure is actually fairly positive here, so we may find that Stockland's find support here at around this 440 level and trades higher. Sonic Healthcare, we like this at 18 times earnings and a 3.8% dividend yield. I think it finds support here at around $20, trades up to 22, and then you'd want to be selling covered calls over it. Not doing there in Santos at the moment. Suncorp just came out with their banking results, and you're seeing within Suncorp the difficulties they're having in growing top-line revenue within the banking sector. I'd look at this sell-off, though, in Suncorp as a buying opportunity. The stock's 12 times earnings on a 6.5% dividend yield. Keep an eye on the selling exhaustion that is likely to occur in the coming days. Sydney Airport's a great example of these yield names correcting off the back of the increase in US bond yields. Sydney Airport's now back on about a 5.5% dividend yield or 5.4% dividend yield. Again, like the other names, I think it can find support off the December rate decision. Don't see it doing too much more than maybe sort of recapturing around $6.75, $7. I'd be cautious that it probably puts in a structural lower high at that level. Same with Transurban. We may see a rally back up to around $11. Don't see it doing too much more than that. Need to be aggressive with the calls to drive the returns, and really have a look at these names much closer around that February-March period in the new year. Telstra, this has surprised me, sort of the selling weakness here. Obviously, all defensive yield names have been treated the same and been shorted heavily. In the case of Telstra, I thought the AGM was encouraging. The company reaffirmed earnings growth that looks like it'll be around 4 or 5%. They've announced they're spending another $3 billion on the network. I got the stock 14 times earnings on a 6.5% yield. The technical structure is negative. So again, I become cautious when we do eventually get a recovery or a rebound in these yield names, just what the technical structure looks like 3-4 months out from where we are today. Treasury Wines has recently been added to the ASX Top 50 index as one of the standout performers of the recent earnings result. Company's delivering something close to 20% earnings growth. I think this pullback here is worth keeping an eye on, and we're starting to see a buying opportunity emerge there in Treasury. We had traded Treasury previously. We were long the stock coming into the result. Then we've taken profit. As the stock sort of pulls back now, I think it sort of comes onto the radar as a potential buying opportunity. Westpac, we may see, as with all the banks, I think their dividend payout ratio is fairly high at Westpac. Maybe they don't do anything in the upcoming result, but towards the middle part of next year or the first quarter of next year, I'd expect to see some plans out of the banks to better manage their payout ratios. Wesfarmers disappointed the market with low growth within their food and liquor division. The stock's now back on about a 4.5% dividend yield. A little bit more than that, about 4.9% dividend yield, trading about 17 times earnings. I think, at a sort of top line earnings perspective for the company, I think if it delivered sort of 3 to 5% earnings growth over the next 12 months, it would be a good outcome. We've been buyers of it down here at lower levels, and whenever it's rallied up to sort of 43, 44, we've sold the covered calls. So over the past few years, we've driven very good returns out of Wesfarmers through being buyers on the dip and selling sort of calls on the rally. And that's effectively what's happened again. Now, we've sold calls at around this between $43 and $44. We've got good premium for that. The stock's back on the support line at the moment. I think the range is sort of 40 to 42 over the next 6 months. Westfield put some numbers on this. It's now back on a 4% dividend yield. I think it finds support here. I think it gradually trades back up to maybe around 9.25. So it seems to be an area of the market where I think we're going to see some buying support come in. Woolworths, the market's treated this pretty harshly as a result of the high PE multiple that it started to trade on. Maybe the market got a little bit ahead of itself with pricing in a turnaround with Woolworths. But certainly the earnings results were encouraging, about 1.5–2% underlying growth. I think that's the first time in about 5 quarters that we've seen any positive momentum within the Woolworths business. But as I've maintained, at around $24–25, it was full value. So we've been fairly aggressive with selling the $25 calls over Woolworths. We had calls at around, I think, $24. They expired, and we've reset the $25. So between the dividend and the call option income, we're bringing in over 10% cash flow there. Woodside Petroleum trading on about 17 times earnings, 4.5% dividend yield. The technical structure's starting to look a little more positive, but difficult for it to perform well in an environment where oil prices are pulling back. And here we are back to the index. So, look, my base case again is that the equity markets are trending higher, higher highs, higher lows. They're under pressure at the moment. It'll probably remain the case into the election outcome next week. I give the market the benefit of the doubt that the structure is still bullish. So unless we really see price breaking down and taking out these lows, our preference is to stick with the uptrend and use the covered calls to enhance the returns, collect the dividends, the franking credits, and sort of have that broader picture in play for how we see sort of the markets unfolding into that December, January, February period, and how we readjust the asset allocations off the back of those that picture that I've spoken about is going through the recording. If you'd like to know more about the Investor Signal service, or if you'd just like to have a chat with me about the strategy and stocks that are commented in today's recording, please don't hesitate to give me a call using the details on screen. Thank you.